much for joining us today. I think we can get started. Right, awesome. So warm welcome. My name is Lisa, and I'm representing the Women of FinTech and SFA today, and I'm going to be your MC for tonight. So warm welcome from the SFA's Women in FinTech subcommittee. We are very excited to host this very first in-person event for us. We have organized some other events online, but this is the very first time we come together in person. Super excited for all of you to be here in the room, but also you online. Thank you so much for dialing in. So to kick things off, why does the SFA organize this event tonight? So the Women in FinTech subcommittee, we are building a professional network for women in FinTech to inspire, mentor, and empower each other. So we are very excited to hear not only from you guys, your experience, but especially from professionals in the FinTech community about their experience when it comes to entering personal and starting your personal finance journey. So without further ado, I would like to invite Amanda, who is the country manager at Stashaway, who is very kindly hosting us for tonight. So she will lead us through the masterclass about what does it mean, personal finance, how to get started, before we then move on to invite some special guests for a panel tonight. So Amanda.
Thank you, Lisa. Hi, everyone. So I'm just going to have a seat here so I don't block you and you can see the slides very clearly. Let me know if at the back you can hear me as well. I'll make sure I speak up. All right, so. Okay. So really quickly, thank you all so much again for taking time out of your evening to join us for today's session. We're really happy to do this event in collaboration with the Singapore FinTech Association. So as I mentioned, my name is Amanda and I'm the country manager for Stashaway in Singapore. These events are something that we host quite regularly. We really do take financial education quite importantly. So for us, this is actually something that we really do enjoy doing every single week. So today's topic is on personal finance made simple. And before we begin, I just wanted to set a little bit of a context so that you know kind of where we're coming from as we talk about some of the topics today. All right. So just a quick introduction to Stashaway. Stashaway is a leading digital wealth manager. So we're probably the most international player as well. Singapore is our headquarters, but we also operate in Malaysia, Thailand, Hong Kong, and the UAE as well. Singapore is our core and largest market. We've been around since July 2017, so we're celebrating our 5th year anniversary in a couple of months. And in a few weeks ago, we actually launched a very new offering for high net worth clients as well. So I think one of the common misconceptions about digital wealth managers is that the first thing you think of it is always retail or millennials. Actually, our core audience is people within the ages of 30 to 45, working professionals that you find in the CBD, so people like yourselves, right? So we're very happy to kind of be here and sharing a little bit more about today's topic. Before we begin, also wanted to share some of our financial backers as well. So we actually raised our Series D round last year, led by Sequoia. You can see some of our other high-profile financial backers as well, including 8 Road Ventures, as well as SquarePac, which is the largest VC fund in Australia. And these are the profiles of our co-founders so that you have a little bit of an idea of kind of the team behind Stashaway. As you can see, they all come from very kind of complementary experiences. Michele, our CEO and co-founder, he spent pretty much the first half of his life in and around financial services in McKinsey. He then moved on to actually Rocket Internet, so starting many kind of fast-growing internet companies. And most recently, he was the group CEO of Zalora before starting Stashaway. And Freddie, he's our chief investment officer, 20 years of kind of multi-asset investing experience, managing billions of dollars for pretty much every bank you can think of on the street. And Nino, he is our CTO, serial entrepreneur, started multiple companies, 2 of which have actually gone on to become unicorns as well. And this is the rest of our leadership team. Just to give also a little bit of background about myself, I've spent the first half of my career in kind of traditional FIs. So I started out at Citi, actually working very closely with institutional clients. I then moved on to a multi-family office doing investment advisory for ultra high net worth. And I've been with Stashaway for close to 4 years now, holding multiple roles. First, leading our client experience team. So if you're a client of Stashaway, you've ever contacted us via WhatsApp, give us a call about your portfolios. That's actually handled by our client experience team. In the past year and a half, I've actually took on leadership of our Singapore business. So essentially handling day-to-day operations as well as more broadly our business development and partnership efforts here. All right. So with that said, let's kind of jump right into today's topic. It is really kind of a investing basic. So you set a great foundation, especially for those of you that have no previous investing experience. If you do bear with me. I think some of these content would be a good reminder for you as well. All right. So first of all, how do you make the most out of your savings? And there are three main ways to make the most of your savings, right? The first way is to have actually financial goals in place. So thinking about what are your goals for retirement? How long do you intend to save for retirement? Are you looking to buy a house in a few years? Are you looking to buy a car? Setting these financial goals is very important, and understanding your investment timeline for these goals are also very important as well. So this is the first step to making the most out of your financial savings. The second thing is obviously to just, start saving, right? Making sure that you're putting aside a portion of your savings every month towards investments or your saving account. And lastly, obviously, one thing that's becoming very important, especially with inflation, is to make sure that you're investing your money, right? Not just keeping your money in your bank account where it's earning right now, unfortunately, next to nothing in interest, and you're losing value every single year, right? So what we're going to talk about today is really drill down on this investing topic and really help you understand, first of all, the basics. So really, what are some of the asset classes that you can actually invest in? So when you hear about things like equities, bonds, real estate, gold, right? I'll quickly run you through these asset classes. The next thing we'll talk about is how much risk should you take? So understanding what your risk appetite is and actually building a portfolio based on that. The third thing is diversification. So, when you're building your own portfolio, making sure that you're not putting all of your eggs in one basket, right? And then the fourth thing to look at fees. So I'll run you through a couple of examples of some of the different types of fees you might be exposed to, as well as kind of, how a small percentage of difference in fees can really, really compound over the long term. And then finally, one question I get a lot from clients, especially at the end of this session where they're really ready to go invest, the first question is, Amanda, when is the best time to start investing, right? So I'll run you through a couple of examples to really debunk that myth that there is actually a bad time to invest. Okay, so let's jump into, first of all, going through asset classes. Okay, and let's begin with real estate, right? Real estate is something that us as Singaporeans, or, if you're Asian, I think real estate is a very, very popular investment asset class that you probably love. And if you look at, if you look outside the window right now, these office buildings are real estate. If you own the house that you currently live in, this is real estate exposure that you have on your personal balance sheet, right? And there are two main ways to get exposure to real estate for retail investors. One is actually to buy the physical asset, right? So if you go ahead and buy a condo or HDB or house, that is an asset that goes onto your personal balance sheet. But one thing you would know as as a buyer of these properties is that when you're going ahead with that process, you probably have to put quite a large down payment on that house, right? That's the first kind of big outflow that you have to make. And then on a regular basis, you have to pay mortgage payments, okay? And for a lot of people, that huge down payment is not something that they really want to do, right? Because what happens is that if it is a large amount, you might have a situation where, you are kind of over allocated to real estate in your portfolio. So what a lot of people do is invest in real estate through something called a real estate investment trust. So what this is that it's actually a company that invests in multiple properties. So you can have a REITs that invest in commercial properties like shopping centers. You can have a REITs that invest in educational properties like schools. And increasingly, you have REITs that invest in data centers as well, right? And REITs is gaining in popularity because for a lot of people, you can gain exposure to real estate with a much lower capital. And, obviously you can get more diversified exposure as well, right? The next thing is equity. So this is something I guess a lot of people know quite well. It's more commonly known as stocks as well in Singapore. And I think it's a conversation people have quite a lot, right? Are you investing in Facebook, Tesla, whatever it is? Okay. And when you invest in equities, essentially what is happening is that you are gaining an ownership share in a company. So the more you invest in a company, the more of an owner you become in that particular company. Okay. And what it entitles you is a couple of things. The first thing is obviously as an owner, you get what we call dividends periodically. So this is a return that a company provides to its shareholders. Okay, so you typically have companies that might pay it out quarterly, for example, and you get a regular cash flow from that. Okay, also as an equity shareholder of a company, you also get voting rights. Okay, obviously, if the more you own, the larger amount of shares you own, the more voting rights you have. Right. So, for example, if a company is up to get acquired or on certain decisions, you might get voting rights for that. We'll quickly contrast that with something called bonds, right? So when I talk about equities, I'm mentioning that you're becoming an owner of a company. When you invest in bonds, you're actually becoming kind of a creditor to either the company or the government. Okay, so you are essentially lending money to one of these entities, and basically what you get is periodic interest payments. Okay, so the same way you think about when you get a car loan or you get a mortgage, for example, and you have to pay interest. This works the exact same way, except that it's a company or the government that's paying you that interest, right? And you get periodic interest payments. And typically, bonds would be considered something as a asset class that is less volatile than equities, because there's a little bit more certainty to the cash flows. Because a company might decide all of a sudden, they might not want to pay dividends, and that is completely at the discretion of the company, right? Obviously, a company that has been paying dividends regularly do not want to stop paying dividends all of a sudden, because what would it signify to you, right? If they've been paying it regularly and all of a sudden they're stopping, right? It's signaling the fact that, hey, maybe that company's has cash flow issues or some sort of issues, right? So typically companies don't stop doing that, but they have obviously the discretion to. While for bonds, they don't really have that, right? It's a contractual obligation of the company or the government to pay you back. So it tends to be less volatile because of that certainty of cash flow. And then lastly, with gold, similar to real estate, you can really get exposure in kind of two main ways. You can really buy physical gold, right? And the problem with that is that you have to think about, how am I going to store it? How am I going to transport the gold around? How am I going to keep it secure? All of which includes costs that would eat into your returns, right? So another way similar to REITs is that you can simply buy exposure to gold on an exchange, right? So it is obviously a very much more liquid way for you to gain exposure to gold. Whenever you want to sell it, just go onto the exchange and sell it, right? So this is really to kind of summarize the relationship between risk and return of these different asset classes. As you can see, stocks tends to have the most kind of variation in expected returns, right? The volatility of its expected returns is the highest as compared to things like short-term bonds or long-term bonds. Really goes back to what I mentioned earlier with, there's a lot more kind of risk you're taking with equities. There's a lot more uncertainty of the cash flow, right? Or the performance. And this is also kind of quite an intuitive relationship if you think about it as an investor, right? You're not going to invest in something that is high risk if it's not going to potentially promise you a high expected return as well. So typically higher risk asset classes has to provide you a risk premium. And as a result of that, the kind of long-term average expected return tends to be higher, right? So with that in mind, we kind of lead on to the second topic we'll be talking about today, which is really thinking about how much risk should you take, right? As you're deciding on a risk profile for your portfolio. And oftentimes, you have people asking their friends and family, oh, what are you investing in? Are you investing in Bitcoin? Are you investing in this stock, right? And then go into the same thing, right? And that is a little bit of a problem because if you think about it, no two people have the same risk appetite, right? I might be a super aggressive investor. I'm super comfortable with, some level of volatility in my portfolio, while someone else might not be, right? So that's why that situation doesn't really make sense, and you want to make sure you evaluate it for yourself, right? And the whole point of choosing a portfolio that's in line with your risk appetite, and we see this a lot with our clients, is that sometimes, when they're choosing a product, they go for the returns, they go for the higher returns, right? And they only look at that. They don't care about the risk that you take. And what happens is that when markets are down 20%, they're kept up at night, they can't sleep, they start panicking, and they potentially sell at the worst possible time, right? So choosing the right portfolio for your risk appetite prevents that from happening. And there are two things to keep in mind as you're evaluating that for yourself. The first one is your investment timeline. How long are you looking to invest? So I'll give you a quick example of that, all right? So this is a quick chart of an equity index and a bond index over the past 20 years. Okay, and as you can see, so the two dips on the blue line, the first one is the early 2000 dot-com bubble. The second one is the 2008 global financial crisis. As you can see, the bond index has remained relatively stable as compared to the equity index, right? Kind of moving up quite gradually. So let's imagine if I have two goals, okay? Goal A is, let's just say my goal to buy a house in 3 years. Okay, I need to put a down payment on my house in 3 years. While goal B is my goal to retire in 20 or 30 years. So that's the end of the line that you see there, all right? Can you imagine if I put 100% of my money for goal A, which is to buy a house in 3 years, into equities? Right. In this instance, my portfolio would be down, 50, 60%. I might not have enough money to put the down payment on my house and have to move back in with my parents. And I don't really want to do that. Right. So what I'm going to try and do in this scenario for my shorter term goal is to probably allocate to more protective asset classes like bonds. right? So at the end of 3 years, I can be assured that my money is going to be there. However, for your longer term goals, so my goal for retirement in 10, 20, 30 years, I have enough time to ride out the short-term volatilities in the market. So the market corrections, the market recessions over the next couple of years, right? And if it's something that I'm comfortable with from a risk appetite basis, then I can afford to take on a little bit more risk. So investing in more growth-oriented assets like equities, right, for my longer term goal. So this is the first reason why your investment timeline is very important, right, when evaluating kind of the portfolio that makes sense for you. So this really summarizes that. You see, my retire in 30 years goal, I've allocated more to growth-oriented assets. My buy a house in 3 years goal, where my investment timeline is much shorter, I've allocated less to growth-oriented assets. Okay, and this is kind of more real example of that. Of a kind of a 50% stocks, 50% bonds portfolio, and 100% stocks portfolio during the 2008 global financial crisis. As you can see, the drawdown is very different here, right? The 100% stocks portfolio went down close to 60% in this instance, right? And for those of you that are kind of clients of Stashaway, you know you can actually create portfolios with different timelines. And this is just a quick fun fact here. As you can see, on our platform, our clients with retirement goals, they tend to have 24 years of an investment timeline on average. People have, you know, a buy a house goal, a traveling goal, start a business goal, right? So they all have very, very different investment timelines. So the second thing to keep in mind when choosing the risk profile for your portfolio is your risk appetite, as I mentioned earlier. So this is, a very personal preference. You can have someone that, grows up, has of the exact same age, grew up the exact same way, but have a completely different risk appetite, right? So it's really, really very personal. And let's just say we have Mark and Rachel here. Both of them have a goal to retire in 30 years. And Mark is just a more aggressive investor. He likes to take on more speculative investments. Maybe he invests a little bit more in Bitcoin. He's fine with that, right? While Rachel is a more kind of long-term investor. Maybe she's kind of more, balanced to conservative. As you can see, because of their very different risk appetite, they've allocated to their portfolios very differently, and that's fine, right? Rachel being more kind of conservative, she's more comfortable with, a higher allocation to protective asset classes, right? While Mark's not so, Mark, would prefer to take on a little bit more risk. However, for the both of them, as you can see, as their investment timeline has gone shorter, you can see that reduction in allocation to growth-oriented assets because the investment timeline is much shorter. They need to make sure that the money is there when they need to put a down payment on their house, right? So the next thing is to also make sure that you build a diversified portfolio. A lot of times when people start investing, they start investing in one stock, right? And that's all they go into, right? And as you can imagine, if anything happens to that one stock, right, your entire portfolio is down, right? So what you want to try and avoid is to not put all of your eggs in one basket. And this is a quick example of that, a very simplistic example, but really just to highlight that, right? So for those of you that remember what happened during the 2008 global financial crisis, prior to the crash, right, there was a real estate bubble where real estate prices in the US was very high, right? And what happened after that when the market crashed was real estate prices fell. And over that same period of time, gold went up, right? Typically gold, considered kind of a flight to safety asset, or when there is a lot of uncertainty in markets, people tend to pile into gold, right? In this scenario, you can see they moved very, very differently, right? So if an investor has simply allocated, let's just say 50% of their portfolio to gold, 50% of their portfolio to real estate, very simplistic example, but the idea is that, some of the gains in some of the other asset classes in your portfolio would help to buffer some of your losses, right? So that's the idea of diversification. If you had everything in your portfolio in real estate, you won't be very happy at the end of 2009, right? So this is an example of what a diversified portfolio could look like. Doesn't mean that, this is the right one for you, but you just want to make sure that it's diversified across different geographic regions, different sectors, different asset classes, right? You might have bonds of different maturities, some gold in there, etc. Right? You want to have at least, 7 to 9 different asset classes, right? And then finally, before we jump into kind of the topic on timing the market, I really wanted to touch quite briefly on fees, which is often overlooked, right? And these are some of the fees that you might be exposed to. I'm just going to quickly run through each of them in turn. But obviously, keeping this in mind as you're evaluating investment products for yourself is super important, right? The first one is an entry fee. So you might have certain kind of unit trusts and mutual funds that might charge you a fee upfront and then just invest the remaining amount. Right, so that's the first fee you might want to take note of. The second one is a management fee. So a lot of fund managers charge you a percentage of your assets under management. Third thing is transaction fee. So if you have a brokerage account, you buy and sell, every time you might be charged a fee for doing so. Fourth thing is a platform fee. Certain platforms actually charge you a fee for just using the platform. So you want to take note of that as well. And then lastly, an exit fee. And this is super important for kind of a lot of investment products where they charge you if you choose to withdraw, or they lock in your money for a certain period of time. If you want to withdraw early, you get a penalty, right? So you want to make sure you really, take note of that, because that inflexibility is a cost to you as well, right? And then lastly, you have the X fee, which is a fee that might not be super obvious in the beginning. Make sure you really drill down in every single scenario, what kind of fees you might be exposed to. And maybe to just quickly run through an example of how important fees are. So let's just say I have two investments, investment A and B, both of which I invest $2,000 every single month for 30 years. Okay, and they both give me the exact same returns, 6% gross returns. And the fees is the only thing that's different here. First one is investment A charges me 0.2 to 0.8% of my assets under management annually, while investment B charges me 2.5% entry every 2 years and 1.5% annual fees. So this is actually quite kind of typical of some of the unit trusts in Singapore. And as you can see here, every 2 years, meaning every 2 years, you're being charged about 4% in fees, right? 6% of returns, 4% in fees. That's quite a lot. So over a 30-year period, that what might seem like a small percentage different over the short term can really compound, right? That's $600,000 difference over a 30-year period. And in retirement, $600,000 is a lot of money, right? It's a difference between you going to Italy every year during retirement and you watching Italy from your TV, right? So if you want to make sure that you are on that trip to Italy every year, right, watch out for fees as well, right? And the last thing is, should you try and time the market? As I mentioned, it's really something that, we get quite a lot, right? People always want to know, when's the best time to invest, or when's the best time to sell, right? That's what you're trying to do when you're timing the market. Okay, so is there ever a bad time to invest? I have some stats here to kind of highlight, to answer that question for you. So as you can see, we have 3 different scenarios. If you see the dark blue box, that is if you had $10,000 and you kept it in cash. So you didn't do anything with it, okay? The light blue box is if you had what we call bad timing. So you had $10,000, you always got into the market at a market's peak, the worst possible time, okay? And the gray bar is if you had perfect timing. So you had like a crystal ball, every single time you were able to get in at the perfect time when the market was at its lowest. So as you can see, over a 25-year period, $10,000 invested at a market's peak, so this is in the 1990s, right, would have actually surpassed the cash equivalent by 281%. Over a 17-year period, $10,000 invested at a market's peak would have only been worth 14% less than the market's bottom, but 80% more than just holding it in cash. And this is during the dot-com bubble, right? A very similar trend, 42% difference between having the worst timing and just holding it in cash. This is during the global financial crisis and a more recent example. So you get my point here, right? So is there ever a bad time to invest? If you have a long-term view, the short answer is no, right? And why is market timing so tough? Why is it so difficult to try and find the best and best times to buy and sell? Right, so there are 2 kind of reasons for this. The first one is typically, the worst and best days of the markets tend to be very kind of close to each other. And then the second thing is also ignoring the noise is challenging, right? So let's drill down a little bit on one. As you can see here, this chart shows you the best days and the worst days in the market. So the green dots being the best, red dot the worst. As you can see, they tend to be very closely cluttered together. Maybe to give you more of a real world example here, more kind of recent real world example, in Q4 in 2018. So for those of you that our fund managers, we remember 2018 being the time where we had 2 market corrections and 1 more close market correction. So it's a very volatile year for fund managers, right? In Q4 2018, I remember being, in Christmas, I was on Christmas break, and I remember kind of my team messaging me, clients were obviously panicking because we had the market correction in December of that year, right? So Q4 2018, the S&P 500 posted its worst 3-month return since 2011. And if you look back at our CIO newsletter at a point in time where we wrote, in Q3 that, economic data in the US was still strong, stick to your long-term investment plan. So clients that did listen to us actually were able to benefit from the rally that we saw in Q1 of 2019, right? May 2019 was the worst May since 2010, the second worst since 1962. Imagine being an investor at a point in time, right? And the month right after that was the best June since 1955. Okay. And this is what I mentioned earlier of kind of also ignoring the noise is challenging. This is in March 2019. What you see on the screen is actual financial media headlines at that point in time. And the line is how markets performed over the same period of time. Right. So I think obviously reading this as investors, trying to even stick to your long-term investment plan can be quite difficult, right? You're very tempted to, potentially sell off or kind of go back to cash, right? But as you can see, that's how markets perform. And what I'm trying to say here is that I'm not saying this is always going to happen, but what we're trying to highlight is that it's very difficult to tell where markets are going to go, right? Even with these headlines. And actually 2019 was a very good year, for the S&P 500. So before we kind of end off, I wanted to just highlight one more example of how much being out of the market for just 1 month can cost you, right? So let's just say you decide you want to liquidate for just 1 month to be safe. So this is an example. We have two investors, investor A and B, both who started investing in January 2015 with $1 million. Okay, as you can see at the start of January 2016, markets took a 10% drawdown there. Investor A, which is the gold or yellow line, he or she decides to stick to his or her long-term investment plan, doesn't do anything. Investment B sees that, panics, sells. So that is represented by that horizontal line that you see. That's the time at which he or she was out of the market, right? Markets essentially bounce right back up. Investor B sees this, decides to get back in. And the difference between the yellow and the blue line is the difference in the value of the portfolio from investor being out for just 1 month. And this is what was happening in markets over the same period of time, right? Very difficult unless you have a crystal ball to be able to time the best entry and exit points. And if you wanted to time it perfectly, you would have to sell at a perfect time and re-enter 3 days after Brexit, right? Which I don't think a lot of investors were very confident at that point in time, right? So this is really to summarize kind of why market timing is so difficult and why, to be honest, what we recommend for investors is to just stick to your long-term investment plan, dollar cost average. So, do a regular investment every month because you don't know where markets are going to go. So instead of putting 100,000 all in one go, we recommend clients to actually, even with us, right? I know obviously 100,000 all in one go for us would be good, but it wouldn't be good for our client, right? And we always recommend them to try and phase it out over a period of time. So maybe $10,000 over 10 months, right? So what are some of the key takeaways from today? The first one is to choose the right risk level for your investment timeline and risk appetite. Start early, right, and construct a very diversified portfolio. The earlier you start, the earlier you get to benefit from the effects of compounding. Watch out for the fees that you're paying. Make it as easy and flexible as possible. Be wary of things where you're locked in, right? And don't try and time the market. Try and dollar cost average, save regularly, and invest for the long term. All right. So that's pretty much it for me. Thank you all so much for taking the time to listen. And I think what we have next is a panel to kind of share some of the experiences as well. And thank you, everyone.
This was really, really helpful to now be on the same page with everyone here in the room and online. So I guess all of you already have some questions that popped up in your head. So now I am very honored to invite our panelists to the stage. So Janice Ko, she's going to moderate the panel. She is the chairwoman of the Women in FinTech subcommittee of the Singapore FinTech Association. We have Lynette Lee from Standard Chartered Ventures, the venture lead. We have Laura Ko over there, Director of Blockchain at Temasek. We have Jillian Lee, Executive Director at DBS Cognitive Banking. And we have Veronika Kuznetsova, Innovation and Strategy Director at UBS Involve. And in the back, you still see the QR code. So I invite every one of you here in the room as well as online to scan the code, because that leads you to Slido, where you can ask your questions later on throughout the panel. But also we have prepared a couple of questions that we would like to address. And without further ado, I would like to hand over to Janice and let's get started.
Thank you, Lisa, for the introduction, and Amanda for her insightful sharing on the basics of financial planning. I think today we're really very honored to have this, our panelists with us this evening. So I think now we would like to switch gear to hear live from our esteemed panelists who will be sharing candidly, right, in terms of their personal experience and how they got started with their personal finance journey, and what are some of their perspectives, right, in terms of personal finance and investing as women. Now, but before we start, let's kick off with a fire round of questions, and we would actually like to invite you, our audience here in the room, as well as virtually, to join us as well. So perhaps, I think, Greg, can we just screen the QR code? So it is very easy to participate, right? So just scan the QR code and then you will be taken to the screen where we will basically screen the questions. Is that the right one? I hope we are not blocking. Sorry, some technical issue. Here we go. Very well. Are we good? Well, I mean, while Greg is screening the questions, perhaps let me just okay, I think there's some technical glitch. So why don't we actually go around with our panel discussion first? Lena, why don't you take a seat? Okay, I think, you know, I mean, to just kickstart, right? Today, we are hosting this event as part of the Women in FinTech from SFA. And I think the reason is to kind of like come around as a group to share how women think about investing, right? So, I mean, from my perspective is that women play multiple roles. You know, we are a wife, we are a daughter, we are a friend, some are mothers. You know, it is not easy to basically juggle all these responsibilities, right? And with these responsibilities, I think our priorities in life tend to gravitate towards fulfilling these responsibilities than putting our own needs, you know, above these responsibilities. So I think myself, I am an example where I didn't actually invest early. Nor did I seek to learn more about investment or do more with my money. So investing was actually not my priority then. And when I was growing up, my parents emphasized a lot the importance of saving from the earlier years. So in my younger days, right, all I knew was to work hard and save money, and that's it. So it was really just savings for the rainy days. And I didn't really have any financial goals in mind, and I certainly was not thinking about any long-term goals. So I look back at it today, I think I do regret the missed opportunities. And but as the old saying goes, right, it is never too late to start. So now with that, let us turn to our panelists to hear from them in terms of how they started with their personal finance journey. So perhaps let's do a robin round and to invite the panelists to share with us, right, in terms of how did you start to incorporate a savings routine into your life? Perhaps maybe Veronica, we can have you to start.
Sure, thank you. For me, it was very kind of standard. I started savings for a goal, and my goal was after high school, I took a gap year and I really wanted to travel. And when my parents heard about my plan, they said, no way, we're funding your travels by yourself. So I quickly realized that I have to work. So, you know, focus on different income streams, but also save for this goal. And I eventually traveled to Singapore, and that's why I ended up here afterwards. That was my story.
Jillian?
Sure. My story echoes a lot of Janice. I'm very Asian, so very kopi. I'm very happy. I don't need a $7-8 Starbucks. So savings is very much in my DNA, in my family. I don't think I have a problem. It's investing that I get stuck. And yeah, very similar to Janice. So that's my story.
Laura?
So for myself, I think I could draw back to the Asian financial crisis in 1997. I actually had a scholarship to, study college in UK, but they only paid for my tuition and not for my board and lodging. And at a point in time, £1 was equivalent to 7 ringgit. So I saved enough, or my parents helped put aside, half of it when, the exchange rate was half. But when the exchange rate doubled, we obviously had, problems meeting it. And at that point in time, I was actually quite aware that, look, at the end of the day, the greatest dividends from your money or investments is freedom. Freedom of choice, freedom to do what you want to do, right? And with that actually started me on my personal financial journey.
Interesting. How about Lynette?
Mine is slightly different. I had very terrible parents. Somebody's telling me not to say anything. So when I was very much younger, I think about the age of 10, they worked me on percentage. I had to give a certain percentage to my brother. I have to give a certain percentage to them from the allowances that I'm getting. So I stopped thinking in terms of dollars and cents and how much I have. So that translated to when I was working part-time because I wanted more. I wanted to enjoy life. I like to go out with my friends. So I did part-time job. I started thinking in percentage. How much should I save? How much should I put aside? What should I budget? So that helped a lot in my savings journey, because then I decided, at a certain point, I did put aside quite a fair bit and it grew, because you need to have a basic amount before you start investing. So that's when my savings actually started building up. And that helped me a lot. So they're not that mean after all, even though they started me on it. Till today, I'm not ashamed to say, they text me on my red packets that we collect during Chinese New Year. I could only spend 10% every year till the age of 12. I get to spend 20% of it. And I realized I need to speed up, because this 20% ain't gonna carry me very, very far. So that's when I start saving, and I do the same thing to my kids too.
I wish I have like mean parents, right, to get me started early. I think this is very interesting in terms of, when everyone is different. So your starting point would also be different, as you can see, even just amongst the panelists, right? I think the starting point is always kind of like a function of your environment, your upbringing, in terms of whether you have people that you will look towards to getting those kind of advice. I think, moving on to the next question, right? It's when did you, savings and all is great, but, with the, with inflation, with the monies are kind of like being diluted or eroded. When did you actually start to take personal finance and investing seriously, and why? Lynette, would you like to have a go?
Sure. Let me just try to count back. I think
Not many years to count back, right?
No, I'm quite old. I think it started maybe about 18 or 19. So it's not exactly like financial investments at that point. I had enough part-time job, and somebody approached me with regards to finance, to insurance, some of the insurance. So I was looking more in terms of like how it could safeguard me for the future, Maybe because of a personal encounter, my dad came down with stroke. So it was something of really important that I look into certain things, how much savings. I started looking into hospitalization, medical. Then from there, I started that as a basic asset class instrument, if you call it. Of course, the returns are not that fabulous, but it's somewhere where I started from. Then I started looking into real estate, various other asset classes that helps me in my investment journey, because I know that I needed to diversify, like what Amanda rightfully said. Yeah, so started maybe about 19, around that point.
19, that's really young. How about Laura? When did you start seriously? I think when I started seriously was really when I started working, right? That's when you have like financial freedom, your first paycheck. What do you do with it, right? I mean, there are many rules of thumbs out there, right? You know, that's the 50-30-20 rule, whereby you spend 50% of your income after tax on necessities, 30% on discretionary spending, and 20% on savings/investments. Now, the 30% and 20% you can easily swap over depending on your personal lifestyle choices, your goals, and your objectives. And then there's also, you know, the recent FIRE movement, financial independence, retiring early, whereby they advocate like saving 75% of your savings. I'm actually one that advocates, you know, taking the pain early and enjoying later. So for me, my savings rate was really high. This was also due to the fact that, you know, in my first early years of my career, I worked with a company called General Electric, and I was on the management programs, and I went from one program to another, and they paid for my lodging, they paid for my food, they paid for my travel expenses. So essentially all my earnings were savings. And so I started on my investment journey really, really early because investment is a passion, is something that I'm interested about. I chose it as a career, obviously, and it was a powerful fun, no return after that. And I've seen quite a bit of dividends from it. Again, another early starter. How about Jillian?
I am a late starter. So
Same
I
like me.
think, yeah, after working, I mean, I did sporadic after I first started work. I think got fed up that I was so useless with investing. So I plonked maybe 5-10K in unit trusts. But it was only, I think, about 8 to 10 years into working. Then I started thinking, when I had my kids, like, what the hell am I doing with my life? When am I going to retire? And I started doing one of those retirement things and getting extremely depressed. Then I started to take investing more seriously. So I would say maybe only 5 to 7 years ago, that's when I really started my investing journey seriously.
Veronica?
Thanks. I think, so for me, I studied economics, and I think I started thinking about investing seriously and consistently when two separate truths or facts dawn on me. One is the fact that, you know, we are a balance sheet. We have our own balance sheet of assets and liabilities. We have income and outflows. And what I realized is that all my money is going for depreciating assets that are not actually ever going to increase in value. So, you know, I'm not getting any richer at all. So I realized that, okay, what are assets that increase in value? Obviously investment. So that's how I started thinking about it. And the other thing is that, of course, everything we buy, it's kind of, we vote with our wallet. So we support the companies that we want to see survive, a big part of our future. So I came up with this really interesting idea to force myself to invest, which is every time I buy something, be it, I don't know, a branded item of clothing or accessory or something, I'll put the same amount of money and I'll try to invest in the same stock if the company is listed, or in an index fund if it's not listed. So that really made me think hard every time before I bought something. And the other thing it made me think is, okay, am I actually, you know, funding or investing in this company being part of the future as well? So it's kind of aligned with my goals and beliefs as well.
I really, really like the forcing mechanism that you have put in place. I mean, this is really fantastic. You know, I think investing, we talk about savings, and then we talk about, you know, embarking on investing. And investing always comes with risks, right? As we all know, and that's probably one of the biggest fear for anyone who wants to embark on it. I suppose, you know, I think we would like to hear from the panelists. Maybe, you know, when you started investing, in terms of how you go about doing it, could you share with us about a mistake that you have made in your investing journey? perhaps we get Laura to start. Sure. I guess it's similar to what you've heard in a masterclass earlier on, right? Too much noise can sometimes cloud your judgment. And what I mean by too much noise, well-meaning or well-intentioned friends, family members offering advice, opinions on your investment decisions. I do believe that, you know, when you have investment strategy, first of all, you need to, you know, do a lot of research, right? And I think as what was laid out in the masterclass earlier on, know yourself, know what are your long-term objectives, know why you're doing that investment, know your time horizon, know your risk appetite. And once you have determined all that, the next step is like, do more homework, right? Make sure you do your research. And, you know, once you've done your research, don't let people around you, be the, what I call the annoying, back passenger in a car, right? Who is always tell you they'll drive here, drive there, go to like 60 miles per hour, don't exceed 80 miles per hour, things like that. It's very important that once you have, identified your investment strategy, you should stick to it and not let your emotions overrun or overrule you. Yeah, so go in with a rational head. Easier said than done sometimes, I know. And, as was said in masterclass earlier, what do you do when you see, the headlines, saying that, oh, we see inflation coming and there's stagflation coming, it seems as if like, the bubble is coming up. What do you do, right? If you have a lot of your money parked in investments, I think that's the point in time whereby, again, what I said earlier on, knowing what are your strategies, knowing your goals and what are you trying to work towards is really important for you to stay the course so that you don't get derailed in your personal finance journey.
Yeah, thanks, Laura. I totally agree with Laura in terms of, not be clouded by the comments or the noises that you're hearing. But I think this will require a lot of discipline in terms of, just shutting yourself out from those noises and not make that kind of mistakes by, somebody tells you, hey, actually, even just today, just sharing, my husband was like, just talking to me and said, hey, have you started investing in this and this and this? And I'm like, no, I don't have time to look at it. He said, you got to, the market is moving. And I'm like, okay, fine. Because I have my own sort of investment approach. So it's very difficult for someone whom you are close with, and then he's trying to give you an advice, right? But at the end of the day, you kind of have to be very, very disciplined and say, I know what I'm going to do. I know what I'm doing, right? Yeah. So maybe perhaps Jillian, I think from a different perspective, maybe you can share with us about a mistake that you have made in your investing journey.
Sure. For me, I think it's just not starting. So I'm a consultant for the bulk of my life. I love analysis. I would download the stocks, look at PE ratios, market cap, blah, 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 and come up with a nice set of stocks to buy. But for some weird reason, I just wouldn't do it. I just wouldn't go in. I don't know why. And I'm not alone. I work at DBS now, and I know that a good chunk of our customers hold all of their assets in cash. I'm not surprised if some of you here would also be like, belong to that category. So I think just not starting and just sitting there is my biggest mistake.
How about Veronica?
I was thinking on this one. I think I've made every possible mistake in investing, which is great because hopefully I've learned. But yeah, I mean, buy high, sell low. Definitely have done that. Last November, I actually bought SEC stocks, which I regret now. Other stuff I've done. I think the one I've really, all of this stuff I don't regret, but the one I really regret usually is when I don't put my money where my mouth is. Sometimes I have a view, I have formed this thought, I've done all my analysis, and I even shared with my neighbor and my friend and everybody who'd listen what I think should, an investor should do, but I don't do it. I don't understand why sometimes. So now, the ability to have confidence gradually built and a discipline and back yourself and actually execute on those investments is just have to start. Yeah.
Yeah, I think investing is quite intimidating, right? But I think at the end of the day, you have to start somewhere. And I think from my perspective is to start small. And then even if you fail, you can still kind of recoup, right? And then from there, you build your confidence. So how about Lynette?
My gosh, my investing journey is worse than the turning roads in Amalfi Coast in Italy. Yeah, and I'd like to go there and not watch from a TV, as what Amanda said. I think taking into consideration a couple of points. One of the things that I felt at once was the penalty fees, which is the exit fee. So it's a very good point to bring up because we get very enthusiastic. Oh, we're very smart. We look into how much subscription we're paying, how much of fees, management fees. And then you forgot, if I need to exit, what happens? Oh, I'll never exit, right? Big failure, because that's what happened. And that was one big learning lesson for me, because I prefer long-term investments. And when I look at the penalty fee, and at that point in time, I needed to take cash out. I've got needs that I need to use it. So it's a huge loss once, but you learn to build up resistance against it. And if you start early, I would say the pitfall is that you grow confidence at a very young age where you don't have a lot of maturity to deal with. I think I got very boisterous at one point when investments came in pretty smoothly. I got too courageous and plus white noises, like what Laura mentioned. I went into looking at penny stocks. I didn't do enough research. That burned me too. Yeah. So these are two takeaways where really know what you're investing in well, be comfortable, set aside emergency funds, especially when it's long-term, look at the fees that is from the beginning to the end. That will really help a lot. Those were two mistakes that I made in my investment journey.
Thanks, Lynette. Yeah, I think in terms of, gaining that confidence, right? It's really about also making sure that you gain the knowledge, be educated about it, know what you are investing, also understand your risk profile, right? In terms of what you are comfortable with. And, I think on this point, I would like to pose a question to Laura in terms of, when it comes to managing your investments, right? How did you kind of like gain confidence?
Sure. I think investing is like sitting for an exam, right? You need to prepare, obviously, right? So do your research. And, once you've done your research, you've done your study, you need to practice. So getting information, arming yourself and equipping yourself with information and knowledge would give you the first blooms of confidence to start your investment or your investing journey. And, after you've gotten all your information, make sure that you don't, just corner yourself and say that, hey, I'm trying to tell a good story, so I'll get information to help support my thesis. You need to get the information from all angles, right? You need to consider information from all angles. There's quite a lot of primary information, sources that you can go through. Let's say if you're buying a stock, read up, the company's, annual reports, read up, the annual quarterly reports and, what management says about the outlook of the company. Don't just stop at the company, look at the competitors as well. So you know what is happening in the industry. Is the success of the company particular to only that company itself, or is it, due to the overall industry growth as well? So equip yourself with knowledge. That's the first step. And once you have gotten knowledge, and even though at that point in time you feel that, oh, okay, I'm not that sure, it's okay, just like, what everyone in the panelists has said, it's okay. Go small first, dip your toes in the water, try to invest a small sum of money. And once you have gained more confidence, then you can start deploying bigger. So that's what I advise. And secondly, just like an exam, after the exam, you should do a postmortem, right? Find out, what went wrong, where you did wrong, and what went right in your investment journey as well, so that you can learn from your experiences and not make the same mistake twice. So follow these few rules, and I think you're well on your way.
Wow, thanks, Laura. I think that's a good advice. I think this postmortem is something that I never think about, because it's like when I lost money, I'm like, I just don't want to look at it. Like, shut the computer, go away. Yeah. So I think we are women within the financial industry. In the fintech space, basically. And I suppose there would be like perception in terms of, we are in this space, right? We are probably a better investor, right? So I think I'm just gonna point this to Veronica, right? In terms of how has working in finance enabled or inhibited you in your personal finance journey?
That's an interesting one. I suppose it applies to all of us here. You know, if this is a FinTech Association event, so one way or another, we're kind of associated with finance. So, you know, for example, I have a CFA, which is, you know, a charter that's considered that someone is supposed to be able to value assets and everything. So I would say the pros are that, you know, it's good for us that we're maybe not so scared of jargon. So our barriers are lower to just go into and start reading and understanding about new investments. And I guess a very important point that I've learned is that we have to stay humble in terms of, you know, every time I decide to go and explore an investment, I also have to go back and do a lot of reading and research, etc. I don't assume I know, which then I guess the cons is that I tend to, you know, think that, okay, what can I not do that an investment advisor can do? So I tend to, and that's one of the I suppose things that I do wrong is that I tend to be a very active investor, and you know, I just like to be self-directed, which is not a great investment strategy in the long term. But it's also, the cons is that it's very time consuming actually. But if you want to do everything yourself, then it means you're going to spend hours and hours, you know, putting in trades one by one, and it takes forever. So I guess the way I think about it is even if you're a sports pro, you know, like a tennis star or whatever, you still need a coach to push you towards your best performance. So it's great to sound off ideas with someone. And, you know, for me, being, I guess, a fintech product lead for investment journeys and products across, you know, from micro savings and investments all the way to sophisticated solution for ultra high net clients, what I realized is that it really comes down to consistent behaviors and habits, managing your psychology, not so much about chasing this one big investment that's going to change your life. It's really about consistency, discipline, you know, and being humble and just kind of trusting professionals and just handing over and delegating some of that work to people.
Yeah, I think that's, you know, I keep hearing about the consistency. I mean, also being sort of humble and, you know, really kind of understanding. And yeah, I suppose, you know, there are some aggressive investors amongst us, but typically women, I think, you know, tend to be a bit more, we take calculated risks, right? So it's not that we're bad investors, but we think a lot, we research a lot, we ask a lot of questions before we make that sort of first step, right? So I think, you know, we hear about Lynette in terms of, you know, how she was forced to start her savings and then make all these investments. So this question I really want to pose to Lynette is, you know, in terms of what do you look out for when considering investment opportunities for the long term?
I think in the past, basically, I look at clearly what was mapped out. Time horizon, what's my goal? What's the percentage that I hope to achieve during a certain point? Because there's a reason why I'm investing, why I'm savings, right? It's not because I can't spend it in a coffin. It has to reach some point where I can use it or to ease my lifestyle. So I always look into time horizon, my risk tolerance level. To a certain extent, I still take into the volatility when I consider long-term investments. I will have a little spread and say, okay, these are the potential gaps in this space, in this industry, or in this particular fund. And I will be mentally prepared to write it out, but I will turn my spotlight to look deeper into it at more frequency during certain points if the volatility for a certain fund or investment is slightly higher. So this will be some of the key points that I look into. Like what I mentioned earlier, I look more into long-term investments. Currently, maybe because I'm in the fintech space and I'm into sustainability, I have more research now to do. I actually start looking into sustainability reports of the company. I try to map back what are they doing, how have they contributed, because it has to be something meaningful and impactful for me besides regular investing at this stage itself. Yeah, so.
Wow, ESG investing, it's a big topic, which I'm still trying to understand, but anyway. Yeah, I think, you know, thanks for all the sharing. And, you know, this particular question is something which is very, very close to my heart. And I really want to ask all the panelists, right, in terms of what is your view on the importance of women having financial independence?
what's your view in terms of the importance of women having financial independence? Maybe Jillian.
I think it's a personal choice. For me, I need it. I'm a mother of 2 kids. So after having my kids, I tried for a while to not work. And not having that financial independence really bugged me. So it's for me, it's personal. I want to have my own income stream so that I feel comfortable purchasing whatever I need, however minute it might be. So for me, I think it's extremely important. It doesn't have to be a huge amount, but you need to have that kind of, I think, emotional and mental, what's the right word? Peace, maybe, that for better or for worse, money can bring. So that's my personal view.
Veronica.
Thank you. I think it's paramount, really, and not just for women, but for anybody to have financial freedom. Why? Because we benefit as a society and as a community, because in that case, people can really focus on their best contribution and, you know, developing their talents and really aligning their life with their actual purpose and goals, etc., as opposed to, you know, just kind of making sure ends meet or being stuck in situations or doing stuff that maybe is not exactly what they really desire. So to me, I think just humanity will benefit if everybody had financial freedom. Yeah.
That's a very well balanced answer. How about Laura?
I agree, Veronica. I do believe that financial freedom is gender agnostic. I have 2 boys of my own as well, 7 and 8. And, you know, even from young, I do, you know, give them pocket money. My 8-year-old would choose to spend his $3 pocket money, $1.15 buying food from the canteen. He enjoys it. Whereas my 7-year-old would save his $3 and prefer to bring food from home so that, you know, he doesn't need to spend any of his own money, right? So it's a lifestyle choice. It's what you get out of it, right? By the end of the month, I would tabulate the savings for my 7-year-old and 8-year-old, and they would compare. And my 8-year-old would say, "Mommy, how come I have less money than my 7-year-old brother?" I'm like, "That's because you chose to spend it, right?" So it's the same for us as adults. I think financial independence is being responsible to yourself, being responsible for your family, and being responsible towards the community as well.
Interesting. This just reminds me to the chart that Amanda was showing in terms of investor A and B, where they started off and it took a month out, and you know, the returns profile is just different, right? So it really depends on like the personal choice, your lifestyle choice, whether you think that saving it, you know, gives you whatever you want in the future, or you want instant gratification. So I can see that in your voice. How about Lynette?
I think it's super important. I divide into 3 quarters, 3 sections: time, money, and power. So financial independence is the money quarter, 1/3 of it, right? And it's important because it buys me the time to enjoy what I want to do. It gives me the freedom to choose. It gives me the power to decide what I want to do, the decisions I want to make in life, to stay in a job, to choose to change something else. You actually need financial means, because many people are stuck in a job they do not like, stuck in a marriage they don't like because of finance. So I think it's most important that you have financial freedom, because that empowers you. When you go back to the other 2 sections, time and power, you need to have the power to choose your own life. Yeah.
Thanks, Lynette. Yeah, with that, I think we have come to the end of the panel discussion. This is really very candid sharing. Thank you very much to the panelists. And with that, I think we would like to open up to the floor here and virtually for anyone to ask any question to our panelists. And if you'd like to ask a question, you can either raise your hand and a mic will be passed on to you, or alternatively, you can also type it into the Q&A section of Slido. And I will be able to pick up the question and ask on behalf of you. Oh yeah, questions. Any live questions? Yeah. Yeah, we're having quite a number of questions actually coming through Slido. And yeah, interestingly, right here, there is a question that so we have a question saying, as a woman, how should we allocate or manage finance for personal investment and for family? I think maybe perhaps I can have Julian to answer this question in terms of, how would you allocate or manage finance for your personal investment and for family?
Well, I can only speak for myself. So Laura mentioned just now the 50-30-20 rule, which I roughly abide by. So I put aside maybe roughly about 15 to 20% for my personal investment. And then for my family, I do it jointly with my husband. So we would both put aside a certain portion, and it's a joint thing for both for our kids. So for example, insurance policies and investments for our kids. And also we both make sure we have adequate coverage in case anything happens to us. Our kids will be taken care of. So we, at least for me, I split it. I think it needs to be distinct. And then the family part is something that I bear together with my husband. Yeah.
So basically you have something on the personal side, and then you have a joint type of, management of the monies. Yeah. And here we have a question, and it says, for a first-time investor, where do you suggest he or she invest the first $10,000? Perhaps maybe Laura, would you like to share your perspective or your experience?
Sure. Well, first of all, we'd like to say congratulations. The journey of 1,000 miles begins with the first step. So congratulations for taking on your journey towards personal investment. I would actually advocate a more diversified portfolio, and it really depends on your risk appetite. Let's say if you have a medium risk appetite, you can do like 50% stocks, 50% bonds, but it's also one word of caution. It's important for you to monitor your the allocation. So for example, let's say if due to market overperformance, suddenly your stocks is rated 80% towards stocks and 20% towards bonds because the market outperformed for stocks. Do reconsider balancing your portfolio again. So active monitoring is important, so you can do the rebalancing and be active and proactive in monitoring your own investments. After all, it's your money and you're accountable for your own money.
Thank you. And we have a very interesting question. And this one, I am going to post this to Lynette. How important is it to you to invest ethically?
Actually, it's very important. I think before sustainability got popular or sexy, I recall I actually stopped buying clothes from one brand. So I echo how Veronica feels when I heard of how much they compensated each person who died in that disaster when the building collapsed. I couldn't live with that. So I don't do, honestly, I don't do fast fashion. I don't buy that. It's important. I invest in companies that I believe in. I believe in the sustainability of the business model, the dignity behind running a business. I'm a serial entrepreneur beforehand. I think there's a certain honor if you want to run a business. If not, it will be called a scam. And so it's really important what I invest in, the people that I choose to invest in, the business model, what they are doing, because it's not just going to impact myself, it's going to impact further generations. I have to walk the talk for my kids so that they are investing ethically too. And yeah, so it's actually one of the key concerns that I look into. Yes.
Yeah, I think this has become, an emerging topic, right? In terms of, as I mentioned just now, ESG, investing, sustainability, we're investing for the good, for the world. But I think it's very important to be very conscious in terms of whenever we make an investment decision, we also know, what we are looking at, in terms of helping the environment, helping the businesses and such like, as what Lynette has mentioned. Yeah, we have
still quite a number of questions coming in. So this one goes, I am 47 years old and have not invested at all except in insurance. Can you share where I should start? Veronica?
I'm going to offer a controversial opinion. Okay, the way that I would think about my first pot of money to invest in as almost two ways. One is it's your learning money. So wherever you end up investing, you're going to, the main purpose is to start your learning journey and grow the investment over time. So whatever happens to it, you know, the important thing is what you take away from it. The second thing is invest in what you believe in. That helped me kind of psychologically deal with the volatility of my investments from early on, because if you invest in something you believe in, you take it much less, I guess, you know, much better when things are volatile or things don't work out, or maybe their value goes through some certain peaks and troughs, because then it's much easier to explain to yourself, you know, I personally believe that, you know, I don't know, digital assets are going to be the future, so I'm going to put my $10 in there, and I feel personally happy that I'm backing my views. Similar with sustainability or ESG or anything else that you know or believe in. Actually, people have different views. You know, if you believe in the growth story for Southeast Asia or China or US or whatever, you know, then it will be aligned with your personal views and beliefs, and also that learning factor.
That's very controversial because, you know, if I were to take that question, right, you know, I think really it depends on, again, your financial objectives. What are your goals? Whether is it for retirement, whether is it to grow your wealth, whether is it to protect your wealth, right? So that will come back to the point around what is your risk appetite? I mean, for me, I started very late in terms of investing, and I'm very risk averse, right? And so anything that I look at, it has to give me a certain level of sort of assurance that I'm not losing my capital. And so for me, you know, the first thing that I get advised most of the time is go and look at REITs, right? You know, that's kind of like the no-brainer. It pays you dividends, and you know, the one thing you will probably need to suffer is basically some price fluctuations, but it tends to be quite stable. So for me, I mean, at you know, starting late, and also again aligning it with your risk appetite is most important. And again, what are you looking to achieve, right, in the long run? So just, you know, in terms of sharing the experience, I think you have to ask yourself, how would you like to grow your wealth or protect your wealth? So it really depends on the objectives.
I agree with that. And I think to add on, you also need to identify what's the time horizon that you're looking at, right? So for example, I think if you look at the long-term average returns of equities, it's generally within a range of about, you know, 10%. If you look at the long-term returns for bonds, it's usually around, you know, 6%, 6 to 8%. Now, of course, as you've seen in the earlier masterclass, high risk, high returns, you know, lower risk, lower returns. So back to, you know, what you've mentioned again, you know, what is your risk profile? What is your time horizon? What is your objective and your goals for investment? How long or how short, how fast do you need to take out that money, and what's it going to be used for? First answer the basic questions, then, you know, you would know, you know, how to deploy the cash, right? So some of these questions are personal, only you can answer. But general rule of thumb, you know, is to diversify your portfolio. As was mentioned earlier, there's multiple, you know, asset classes you can look at, you know, equities, bonds, alternative investments, you know, like crypto. I'm not an advocate for it, but, you know, it's there. You know, there's also like PE, VCs, you know, wine, art, you know, gold, commodities, etc. Most importantly, you know, people come up and tell me that, hey, I'm actually diversified. And I say, how are you diversified? Oh, I buy energy stocks. I buy, you know, real estate stocks. I buy consumer stocks. I'm like, yeah, great. You are diversified from an industry perspective, but you have all your money in one asset class. So that's not really diversification. So, you know, again, you know, going back to the fundamentals of what we've just mentioned.
Yeah,
Thanks, Laura. I think the point around the time horizon is very important as well as part of the consideration, right? I mean, for me, I always have this idea of retiring young. So I give myself very short time horizon, and then whenever I share this with friends, they'll be like, how are you achieving this without even starting to invest? And I get those question marks from them, right? So it's kind of like living in my own dreams anyway. I think we have come to the end, although we still have quite a number of questions that's not being answered, but feel free to sort of email to Stashaway and even to us, Women in FinTech at SFA, and we are happy to share our experience and advice. Again, this is not investment advice, but it's really more about sharing, what our personal finance journeys are. And so I think, thank you so much for spending the evening with us. And let me pass over to Lisa. And thank you to all our panelists.
Thank you so much to the panelists. That was really wonderful to get your personal insights and experiences. Again, this is not investment advice. This is really just sharing what each of them is going through or went through. However, for those here in the room, you can still stay with us for a while to address your questions directly to the panel, to Stashaway representatives, to SFA Women in FinTech representatives. We actually have a few over here as well on the sofa. So very happy to answer more questions. And for those dialing in virtually, please do reach out via email. We can also help you find your right membership if you're not a member of SFA yet. I'm very happy to guide you through what else is in store. Gathering from the questions in Slido, there's definitely many more events to follow up on, so do stay tuned. If you want to learn more about Stashaway, feel free to also scan their QR code if they want to flash it up. And with that, thank you everyone for joining us. And for the panelists, we still have the gifts. So thank you so much again for your time, for joining us today. And we have a small token of appreciation.